you know, ideally we should have as well bring in the interest, right? Now we should have said what we want to bring in the interest. But even information about the interest, we were not told that in some cases Ican may decide to add that okay, the interest will also be grew by 5%. So what if they added interest here, right? Class, what if they decide to say, okay, the net interest cost will increase, there will be an expected annual growth rate, just like others, right? So which means that we need to also grow the net interest. So when you get your operating profit, right, you less your interest. When you less your interest, you have your profit before tax, then you charge your tax, you have profit after tax, you can now add back the non-cash item. Should in case the net interest, don't forget that under the free cash flow, we did something, under the free cash flow, under valuation, we did something like that, oh, they say the interest will also increase by 5%, which will also grow it by 5%. But there's no information to that. So that is why we just have to do what? We skip that part because you cannot just assume that it is still the same figure for the next 4 years. So what do we have here? Quickly, figure.
1523.
Okay, come. Okay, 1523.
23.
Okay,
1599.
okay.
1679.
Next.
1763.
Okay, so this is the only non-cash item that's already been added. And then being we're given information about the net interest, right? The net interest cost would have come to this side and say net interest, then we now grow it by that percentage, right? And we'll still come back to this part and say what? Add back non-cash item, net what? Net interest. But such information was not given. So in this case, we move ahead with what is given to us in the question, right? Then what else? We're given the replacement. Replacement is on also asset replacement. Then asset replacement will still increase by 5%. So let's quickly go back to the question where it was stated that the asset replacement, can you see it? By 5% the next 4 years. And here we will also be they give us what 1,600 as the annual replacement. Anything you want to grow, they must give you initial figure that you will use to grow it. And that is one of the assumptions that may not be what reliably accurate, that may not be what accurate, class. So asset replacement, what is the figure given to us in the question? 1,000 something.
600.
1,600.
16.
Okay, times 1.05. So what do you have? You can see that the asset replacement, if they say there is a growth, what it means is that the replacement, the asset replacement will actually increase. So when the asset replacement is increasing, what will happen to your cash flow? Your cash flow will definitely what reduce. Class, give me figure. Esther.
Okay. For the first year, we have 1680 naira. 1680.
Okay.
Then 1764.
Next.
1852. 1945.
Okay. What is the present value? Figure. Give me figure from quickly. Figure.
Two one nine five.
Okay. Okay. Pemisire, are you in this class?
Yes.
Good
Good evening, sir.
good evening. Are you
Yes,
still
I'm
with
very much
us?
with you.
Okay. Or against us?
Yes, yes.
Okay, you are not against us. Okay. Yeah, with us. That's fine.
No,
Okay.
I'm with you.
Okay, okay, that's fine. So, okay, okay. Esther, go ahead quickly.
The network is breaking. 2195.
Okay. Okay, your network is breaking, right? Okay, Pemisire, please, you also be at the
Yes,
background. You also be at the background. Okay, Esther, continue quickly.
no problem.
Okay, the first one
Oh,
is 2195. The second one is 2305.
Okay.
2420. Then the next one is 2541.
Okay, so we have to discount it with 9.84%, right? 9.85%. What is the DCF? What is the DCF? Quickly, year one, year two, year three, year four. Rachel, we, hmm, who will give me figure by? Let me see. Oh my, or is it my network?
0.91
0.10.
for the first year.
0.910. Don't forget three decimal, right? Next,
0.828.
0.828. Next,
0.754.
next.
0.687.
Okay, okay. So what is the free cash flow?
Okay, the first
Free
one.
cash flow. Okay,
1997.
1997.
Second one, 1909.
1909.
Third one, 1825.
1825.
Last one, 1746.
746. Please confirm if all these figures are correct. One seven
They
one
are
one
correct, sir.
seven what? 17 what?
Yes,
1746.
1740.
Okay. Okay, that's fine. If this is correct, okay. So this is our free cash flow, right? So we can now have free cash flow from year one to year one to 4, right? Free cash flow, or you can say the market value, total market value from year 1 to 4. So what is the total? When you add it together, what do you have? What is the total value of the business? What is the total value of the business?
7477.
Okay, that's fine. 7477. Also done. Please, presentation matters a lot, please. 7477. Okay. 7477. Right. Now, are we done? No. Now, let's quickly go back to the question. Excuse me. Now, don't forget, in this same question, we're told that the expected annual growth rate in sales, operating costs, including depreciation, replacement investment, and dividend after 4 years. That is to infinity. Is that not so? And that is 4%. Now, when you want to do to infinity, what it means is that all those things that they mention, it has already been included here. Is that not so? That is what you use to get what? 7,477. But the next thing is thereafter, after 4 years. Class, after what? After 4 years. Now, in this case, right? So if this is okay, if this is if this is from year 1 to year 4, don't forget we've already discounted to the present value to have the current value of the business, right? So in this case, from 4 to infinity, right? Don't forget thereafter. Is that not so? So I can pick this. Don't forget there are 2 ways, right? I can pick this 7477. Then you grow it by 4%. Class, you grow it by 4% stated in the question. You grow it by what? By 4%. So times 1.04 divided by the costs. Don't forget the cost you use to discount it, because you divide it by your weighted by your weighted average cost of what? Capital that you use to what? To discount it. And then being it is free cash flow to equity, you would have used equity. So in this case, what did you use to discount? You use 0.0984 minus the growth rate. What is the growth rate? Is 0.04. Right? When you have this, then you will have to infinity. Class, what is the figure? Figure, please. Figure. You can't see my screen. It's your network. Oh. Others should confirm if they can see my screen.
I can see your screen.
I can.
Okay, it's your network. Okay, quickly. The main work is the combine, please, so that we can finish it up, please. Figure.
133,152.
What do you have? What?
133,152.
Wait. 133 here.
I'm thinking it should be the cash flow should be the one of year 4 instead of 7,477.
Okay. I'm coming. That is 2, 5. Oh, that's true. Well done. That's true. 5, 2, 5, 4, 1. You grow it, then you now discount it of 0.687 times this. Okay. Give me figure now. Let's see. Figure. Let me see.
31087.
31087. Let me see. Any question?
Yes, I'm here.
Do you have question for me?
087.
Yes, my question is where
My
did you
question
get
is where did you get 0.0?
Esther, please mute your mic.
Yes.
Esther, please mute your mic.
Okay, go ahead.
Can you hear me now? Yes, I said
Yes, I
where
can
did
hear
you
you.
get 0.0?
Ah,
I understand 1.04 is the growth rate.
This is it. The usual way that it's supposed to be if it is free cash flow to equity, it's supposed to be equity here, right? It's supposed to be the equity this year, right? Now, what you use to discount it, that is what you will use to minus your growth rates. Do you understand? If you convert this 9.84 divided by 100, just like the way we normally do free cash flow to equity to infinity. Do you understand?
Yes.
Okay. This is total market value. All right. What is the total market value? Please, what is the total market value?
38570.
38570. So this is the total market value of the acquiring company. Do you know what we want to achieve? Because we want to know if there will be any benefit in the acquisition. That is why they say do the combine. Do for each of them, then do the combine. Then we can now we can have any increase or decrease, right? That arise as a result of the combine. Don't forget, if we do combine, some of all these costs will decrease. So we want to know, do we have any synergy? Will our profit increase as a result of takeover? And that is the objective, right? And that is the objective. Any other question? If you have question, unmute your mind before we move ahead. Okay. Now, since we've calculated the weighted average cost of capital for the acquiring company, so we need to calculate for the acquired, which is the target company. We need to do the same thing. Oh, this is 20 marks. Interesting. Interesting. Okay, we need to calculate for RT, right? The same pattern. So we need to get the weighted average. Okay. So RT, right? So we need to get the cost of equity. Don't forget the equity beta are different, right? They have different equity beta. So that is why the cost of equity will be different, right? Because they have different equity beta. Cost of equity equals to what is the risk-free? What is the risk-free class?
4%.
4 plus what is the equity beta of RT? Equity beta
1.38.
1.38. 1.38. Now the market return. What is the market return?
11.
11. 11 minus 4. What is the cost of equity? What is the cost of equity?
13.66.
13.66. You can approximate to, so whichever way you want to do it. So it's right. So we need to do the level of gearing. The gearing is still the same as debt divided by debt plus equity. And don't forget, this is debt. The level of gearing is equal to what? Is equal to 55%. Can you see it? Class, the level of gearing here is what? 55%. So, which means that your debt will be 55% divided by 55 plus what will be your equity class? Equity will be
45.
45.
45.
Okay,
45.
okay, that's fine. So, which means that the value of equity, is 45, while the value of debt is 55. Excuse me. So therefore, the weighted average cost of capital, we're supposed to have different tax rates. Is it the same tax rate given to us? So that is part of the assumption. It is assumed that the tax rate given to us is for both company, the acquired as well as what? The acquiring company. Right? So the value of equity is 45. The cost of equity, if you convert this cost of equity, you will have 0.1366, right? So value of equity, what is the value of equity? 45. Then value of debt, 55. Value of debt is 55. Cost of debt, okay. The cost of debt is pre-tax, not post-tax. So now let's check what is the cost of debt given to us in this question, right? Which is the fixed interest debt, 7.5%, right? 7.5. So we can have 7.5. So the tax rate minus tax rate of 0.3, right? 0.3. What do we have here? What is the figure?
5.25.
Okay, 5.25. Okay. 5.25%. Right? So the 5.25%, okay? Or if you convert this, what do you have? You have
0.0525.
0.525. Okay. Thank you. Okay, 525. Okay. So here we can have 0.0525, value of equity 45, value of debt 55. So please, I need final figure. WACC. What is your WACC? Final figure here. WACC.
Walk.
9.03.
9.0. Oh, it's 9.0.
Oh,
That is
9.0.
9%.
That is 9%.
Yeah.
Please, any
Please,
question?
any question?
Okay.
Okay.
Esther, mute your mic.
Esther, mute your mic.
Sorry.
Sorry.
All right, thank you. So next, we need to do the free cash flow just the way we did this, right? We need to do the same thing, right? We need to do the same thing. Okay. So this will be RT. Excuse me. Right. So this figure will change. So what is the sales? How many percent will the sales increase? Now let's quickly check back. Go back to our question. Can you see it? The sales will increase by 6.5, right? The sales will increase by what? 6.5, right? 6 point what? 6.5. That is 1 point. So what is the sales? What is the sales figure of RT? The sales figure here is 9,400. So we have to inflate it. We have to jack it up, right? 9,400. So this is 1.6.5, 1.065. So please, what do you have? Figure.
10.011.
10,011. Okay. Wait, Esther, are you tired?
No, sir.
Okay, that's fine.
Okay, that's fine.
Next.
Ten
Ten
six
six.
Okay. Next. Esther.
Yes, sir.
Esther,
Esther,
just relax.
just relax.
Rachel, you can give
Rachel,
us
you
figure,
can.
please. Quickly.
11.355.
355. Next.
12.093.
So we move to the operating costs again. We need to add the depreciation for RT. Then we jack it up, right? We need to add the depreciation. I just need to copy this, right? We can adjust. Okay, so we need to check what is the operating cost. What is the operating cost for RT? Operating cost is what? 5450, right? 5450. What is the depreciation? Give me the depreciation figure quickly.
1,100.
1,100. So, and all will increase by 1.065. Don't forget that you may be given different rates, right? You may be given 2%, 3%, just like the way we did under the free cash, under valuation, right? Under the valuation of a business. So please give figure for the first year. Figure for the first year.
6976.
Okay, 6976. Next, just increase it by
7,429.
1.06. What do you have?
749.
Okay, 7429. Okay,
7912.
7912.
okay, 7912.
8426.
8426. 8426. Okay. See that the thing itself is not easy to we are in this together as well. So what is the profit? We're almost done. What is the profit? What is the operating profit?
3,035.
Okay.
Okay.
Next.
3,233.
Next.
Next.
3,443. 3,667.
Good. Thank you. Tax 30%. So what is the 30%?
The last one, 1100. 30% of the year 4. 1100.
Oh, 1100.
Year 3, 1033.
Year 3. 1033. Okay.
Year 2, 969. That would be 970 after approximation. 970.
970.
Year 1, 9911.
All right, thank you. So the profit after tax, profit
Yeah.
after
2124. 2263. 2410. 2567.
Please, others should
Please, others
confirm
should
the
confirm
figure.
the figure.
So we need to add back the depreciation that is included there, right? We need to add back the depreciation. Depreciation. What is the depreciation amount for this? Let's quickly check. The depreciation is 1,100, right? Okay, we've done it for 1,400 times, we'll multiply by 1.065. 1.065. What do we have? Figure.
1172. 1248. 1329. 1415.
Okay. Okay. So increase in asset replacement, right? Okay, what is the asset replacement costs? 1,240. 1,240. 1,240, and it will increase by, is it increasing by the same amount? Okay. 1.065. So figure please.
1321. 1406. 1498. 1595.
Okay. Thank you. Thank you. Okay. What do we have? What is the present
Addition.
value?
This thing is addition, no, not
What is
subtraction.
addition? What is addition? Increase in the asset replacement.
Okay, sorry.
Okay. What do we have? Quickly. Hello.
The first one 1975.
975.
Next.
Next.
2105.
2105.
2105.
Yes. 2241. And 2387.
Okay. Thank you. All right. Makes sense. So, okay. I need to copy the. Okay, just a minute. Let me copy all these things here. So, you need to rewrite them again. Okay, market value from year 1 to 4. Please add the market value from year 1 to 4. What do you have? Market value from year 1 to 4. What do you have? Oh, we have not discount self. Oh, we can actually use an ETO, but no, I don't want to use that method. DCF is 9%, right? We can actually use something to. Okay, please, what is the DCF for this? Quickly.
0.917.
Okay,
Okay.
0.842. 0.772. 0.708.
Okay. Figure. Excuse me.
1811.
1811. Okay.
1772.
Okay.
1730. 1690.
Okay, that's fine. Thank you. So, what is the present value? What is the market value from year 1 to 4? What is the market value?
7003.
Okay, 7,003. Okay. So don't forget to infinity. Let's check what is the infinity growth rate. Oh, the infinity growth rate is 5%, right? The infinity growth rate is 5%, right? Infinity growth rate is 5%. So the last the last present value here, the last cash flow, sorry, the last cash flow here is what? 2,387. Can you see it? 2,000 what? So let me put it as free cash flow. So the cash flow is 2,387. Now the growth rates, don't forget the growth rates thereafter is 5%. Is what? Is 5%. Can you see it? Is what? Is 5%. So we quickly say it is 5%. 0.5. So what is the last DCF here? Is 708. Then what is the DCF? The DCF you use, class, you use the DCF, right? Like the formula. 0.09 minus what is the growth rate, class? The growth rate is 5. So what do you have here? Figure.
44375.
44375.
375.
So when you add this, what
When
do
you
you have?
add this, what do you have?
51378.
Okay. Don't forget what we want to achieve. We want to know, why do we have to do this? Because of the combined company. Because of the combined. We want to know, is there any synergy? Because you calculated the free cash flow for each of the individual. What is synergy? Synergy means that there is an increase in the combined company. Company A and company B, right? Synergy occur where the combined company revenue is greater than individual, right? Is greater than what? Individual. How much synergy? We want to know the profit increase. If we decide that, okay, we want to combine, then before you can be able to calculate that, you need to get the free cash flow to the firm for each individual company according to the question of each individual company and the potential combined. Don't forget, immediately after all these figures given to us, we're told that the takeover is expected to result in cost savings, right? In advertising and distribution, reducing the operating costs, including depreciation of PACO, from 76% of sales to 70% of sales, right? Don't forget, your operating costs include your advertising, distribution, right? Then your operating costs will now reduce to 70% of the sale. then what will happen? The growth rate, class, the growth rate of the combined company is expected to be what? 6%, class, which means that the growth rate from the sales to operating, from operating, right? From operating to asset replacement to your depreciation, right? We grow. It is expected to be 6% for 4 years. And we will now do the year after. So combined now, class. We need to combine the two company together. So we want to combine them, right? So when we combine the two company, we will compare it when they are individual. When it is what? When it is individual. What do we want to achieve? We want to know if there will be synergy. Class, what is synergy? Synergy means profit. If we want to know if I merge with Esther, are we going to achieve profit? Are we going to have more profit at the end of the period? That is synergy, increase in profit, class. Synergy, you will, as we move on, when we get to merger and acquisition of share for shares, you will still see different language from there, right? Right? Now, the question on that share for share could be that, oh, if this person wants to take over, what is the gain or loss on the what? On the share for share exchange? We'll get there, right? We'll do what? We'll get there. Don't forget, all valuation takes 30% of the syllables, right? 30% of the syllable. Don't forget, it's usually a compulsory question, right? Usually a compulsory question because it takes like about 30%. There was a director Ican set like 4 valuation questions. The compulsory question was on valuation. No, it's not on share to the method of valuation. The second one was on fundamental and technical analysis. The third one, I think the fifth one was on the share price, which we've done that in our previous lecture. The fourth one as well, right? About 4 to 3 questions under valuation of a business. So that is why we need to treat more questions on valuation, right? So we need to determine the combined company now. Combined company. Class, are we still together? Are we still together, please? Hello?
Yes,
Yes,
sir.
sir.
We are together.
Okay. Where is the exclusive? Oga Samson, the powerful.
I did, sir. I did, sir. The price calculator on the background.
It makes sense. That's fine. Okay. The combined company, right? The combined, please, the presentation, right? All these things are 1 mark, please. And 1 mark is very important, so please. Combined, PART2, and please, your Naira sign, everything, please. They are very important. PART2, right? Free cash flow to the firm. Free cash flow to the firm. So I can copy all this year 1 to year 4 of the now combined. Okay, class. Now let's quickly go back. Now combined, class. I've explained this combined in our previous lecture, right? You want to take over A, B. A wants to take over B. What is the combined sales? Combined sales for the year is the sales. Maybe A make a sales of 20 naira. B make a sales of 30 naira. Combined, addition of the 3, addition of the 2, we have 50. That is the combined, right? Now, when there's a combined company, some things will change. That is one of the advantages of what? Merger. What? The cost will reduce. Is that not so? And we see what play out here. Is that not so? The cost will what? Will reduce. Now, the first thing is that we start from our sales. Don't forget, the growth rate of the combined company is expected to be what? 6% for the next, see, all the growth rates of the combined company, because we want to do free cash flow to the what? To the firm. All the growth will increase by 6%. That is what it means. And 5% thereafter. Now we start from the sales, right? Don't forget it is combined. Combined sales. So you give me the figure. What is the combined sales? Original sales for Paco and Acti. Quickly. What is the sales of Paco?
13,333.
13,333 plus what is the sales of Acti?
9,400.
9,400. Good. So times 0.6. Class times what? 0.6 of the combined. And that is what you will do. Any day, anytime you want to solve a combined company, you add the total revenue, then you grow it by what is given to you, right? What is given to you, right? And that is it. So class, what do you have here? Quickly.
2407.
24007
097.
97. Okay. Next. You grow it, you increase it by 1.06.
25,543.
25,543. Next.
27,076.
27,076. Next.
28,701.
28,701. Right?
Yes, sir.
Okay, that's fine. So the next is the operating costs. We combine the operating costs. Don't forget, they say any growth will increase by 6%. That is what it means, right? You are not given anything that sales will increase because of the combined. No. And why sales is increasing is because of the synergy, right? Because they will make more money, right? So give me we need to add the operating costs. Don't forget what was given to us. We were told that operating costs, let's quickly go back. We reduce, including what? Including depreciation, right? Including depreciation, we what? Reduce to 70% of the sales, which means that your operating costs will now reduce to 70% of the sales, class. So in this case, we can now say operating costs, right? 1.06 of sales, right? For year one, what do you have? 1.06 times 24,097. What do you have? Operating costs. Oh, sorry. 70%, Abi. Sorry. 70% of sales. 70% of sales. Class, are we still together? Are we
Yes,
still
sir.
together? Favor. The call will end in 4 minutes.
I'm with you. I'm with you.
Okay, that's fine. So when it is 2 minutes to 3 minutes, just let me know quickly. Okay, 70% of all these sales, what do you have?
16,868.
16,868. Next.
Last one.
7,880.
17.
880.
Last
Okay.
one, 2020091. The last one.
Okay. Third one.
18.
18. What?
953.
Okay. Okay. That's fine. Okay. So I need to create another link so that we'll continue our lecture from there, right? We need to complete this question before we go. Thank you. Thank you. Thank you. We need to continue, right? So now, so what is the operating profit? What is the operating profit? Operating profit, right? What is the operating profit? Figure, please, quickly. What is the operating profit?
7229.
7229. Okay.
763.
763.
8123.
I'm coming. 7663, right?
Yes, sir.
Okay, next.
8123.
81. Okay.
8623.
8123. Okay, next.
8610.
8610. Okay, that's good. So what's next? Tax, right? Tax. The next is to charge tax, right? The next thing is to do what? Charge tax. Okay, let me bring this down. 30%, right? So what is the 30% of this? Quickly. What is the 30%?
2169.
2169. Okay, next.
2299.
Okay. 2299. Next.
2437.
2437. So what do we have here?
258. No,
2583.
2583.
2583. Okay, that's fine. Okay, please just what is the profit after tax?
The last one, 6027.
I'm coming. What do you have, sorry?
6027.
027. Okay.
5060 for the first one.
Okay. 5060. Next.
The third one, 5686. Third one.
5 what?
5686. 5686.
5686. Okay.
The second one is 5364.
Okay. 5364. Right.
364.
Okay. That's fine. So we add back the non-cash item. we add back the non-cash item, right? Okay. Which is the depreciation that was included in the what? In the operating costs. Okay. Add depreciation. Now, don't forget that before they arrive at 70% of the sales, they've already indicated, it is indicated that it's shown that it includes depreciation. Is that not so? But the depreciation figure, we already know the depreciation figure for PART2 as well as RT. Is that not so? So, and don't forget that, and it must be inflated by what? By 6%. We must grow it by what? By what? By 6%, right? Okay. Now, so depreciation, what is the depreciation for PART2? What is the depreciation figure for PART2? Depreciation figure for PART2,
1450.
1450 plus
110.
okay. So there will be a growth rate still the same 1.0 what? 1.06. Figure, what do you have here?
2703.
2703. Next,
2865.
2865.
865.
Next,
3037.
3037. Next,
3219.
3219. So asset replacements, don't forget it will increase. Don't forget the combined class. Don't forget combined. What is the asset replacement of PART2? And what is the asset replacement of what? The asset replacement of RT. So we need to do what? We need to add it together. Combine. Is that not so? So what is the asset replacement? Let's quickly check. What is the asset replacement? Can you see it? 1,600 and 1,240. Class. 1,600 plus 1,240. Don't forget, and they said there will be a growth rate. 1.02, right? Please, oh, gifted, please mute your mic. Okay, so what do we have? Figure increase. What is the negative? Increase. What is the increase?
3010
3010.
for the first one.
Okay.
3191.
3 what?
3191.
Okay. Next.
3882.
Next.
3585.
It's 3382, not 3882.
3585. You said what?
The third one is 3382.
Okay. All right. Okay, that's fine. So are we good? So next, what next? What next? We have our free cash flow, right? Free cash flow. Free cash flow. Please don't write free FFC. Write it in full, okay? Free cash flow to the firm. Uh, Okay, figure.
Year
What is the
1,
free cash?
4753.
Okay, 4753.
Year 2, 5038.
5038.
Year 3, 5341.
5341.
So I've not done number 4.
Okay.
5561. 5561.
I'm sorry, 5661.
Okay, 5661. Okay, so which DCF? I know some students will say the DCF, we should combine it as well. Since it is combined company. Don't forget, excuse me, it was stated that the weighted average cost of capital of the combined company is assumed to be what? To be 9%. Class. It is assumed to be what? To be 9%. So don't assume that it is the one of takeover company. Oh. Can you see it? It is assumed to be what? 9%. So therefore DCF of 9%, right? So I just need to copy what's the DCF of this, right? I just need to copy the DCF. Okay. Figure, please. You can unmute your mic. If you have question, you can unmute your mic with the person that has question. Rachel.
Okay, sir.
Rachel, quickly.
Is it possible for the examiner not to give us the combined weighted average cost of
I know. See, I know you will ask. Interesting. Well, I don't. I've not seen like something like that, right? Most time you will be given, right? You'll be given because it is assumption. You'll be given, right? You'll be given. Thank you. I know you asked. I know. So, next figure. Figure, please.
4359.
Oh, sorry. Hold on. I need to plug my phone. Sorry, a minute. So you can unmute your mic. The person still unmuting your mic. If you have question, unmute your mic. Oh, okay. I guess there's no question now. Right, okay. That's fine. Okay, please figure.
The last one, 4008.
4008.
The first one, 4359.
4359.
The second one, 4242.
Okay, second one is 4242.
The third one,
The third one,
4123.
Say?
4123.
Okay. Okay. Thank you everyone. So what next? So we just need to, don't forget we have thereafter as well, right? I need to go back to the question, right? So that you see it. This is the combined company, right? Okay, combined company. Okay, now, can you see it? 5% thereafter. I think assuming this 5% thereafter is not there, right? Would have just add and just get the market value, right? Would have just add from year 1 to year 4, right? And leave it like that. But there is thereafter, right? And 5% thereafter. Class 5% thereafter. So that is to infinity. So what is the total market value from year 1 to 4? quickly before we go.
16732.
16732. So you pick from your last cash flow because it is from year 4, right? 5661. Can you see it? 5661, right? Times what is the growth rate? Let's check. Thereafter is by 5%, 1.05. Then the last DCF is 0.708. The cost of the weighted average cost of capital is assumed to be 9% that we use to discount. Then the growth rate is 0.05. Class, what do we have? Quickly.
105210.
1.5.
105210.
Okay, 105210. Good. So what is the total?
121942.
121,942. 942. Okay, that's fine. That's fine. That's a very good one. Well done. Thank you. Thank you so much, everyone, for giving me these figures, right? Come on. Tired though. So we are done now. Are we done? No. Right? We still have the synergy, right? Now, class, let's quickly go back to the required. Now the question is, and the potential was, estimate how much synergy is expected to create from the what? From the takeover. From the takeover. What is the synergy? What it will be the increase in the profit? I think we want to combine together. We want to take over the business, right? What will be the synergy, the profits as a result of that, right? So therefore, your decision, you can just write decision here first. Don't forget, okay? I'll copy this. So, Paco, what is the market value for Paco? Market value, total market value for Paco. Total market value for Paco. Okay, I need to just shift this one here. Okay, total market value of Paco, quickly.
38570.
38570. Okay, good. Okay. 38570. So what is the total market value of RT? RT, the market value?
1378.
You said?
51378.
Okay,
378.
51378. Okay. So what is the addition of these two? Interesting. I'll explain. Synergy. What is the addition of the two? Is this figure correct? RT 51378. Okay, 51378. Okay, that's fine. If you want to ask question, I need to finish this first. So addition of the two, what do you have? Addition of
89948.
89948. Good. Now, what is synergy? Synergy means that the combined company, right, the combined profit, the increase, let me say, how should I put it? Increase in the that arise in the increase in the profit that arises as a result of combined company, right? Uh, how should I put this in? Okay, the synergy, right? 2 plus 2 is equals to 5. What it means is that the combined company, if we have a combined company, we will have more profits than having a separate what? A separate company. Separate what? Separate company. You can see that when they operate separately, right? The total value is 89,948 class. Now, what is the combined market value? What is the combined market value? 121 class. Interesting. If I'm the owner, if I'm part of the board of Paco, I can even pay times 2. Class, what is the difference? The difference is called synergy. Increase in synergy. Why? Because if I take over RT, the market value of the business will be 121,942. But if we want to do separate, operate your own, I operate my own, right? We will have 89,948. So therefore, there will be an increase in the profit, in the value of the business if Paco take over what? RT. So what is the difference? Don't forget, synergy means profit, value. What is the difference?
31,994.
31,994. What it means is that the management of Paco to take over RT, because there will be an increase in the profit of the business when they combine. Don't forget, when you combine 2 companies, merger, right? Or you acquire the business, you have some benefits. It could be a revenue synergy, it could be cost synergy, it could be financial synergy. So in this case, when they're not combined, don't forget, in the question, when they're not combined, there is cost synergy, there is revenue synergy. The financial synergy was not stated, class. Am I communicating? So we are done with this question. This is 20 marks. So when they say you should do the combined market value, don't forget, it is both the acquiring and both acquired company together. You discount them, you have your combined. Then what is their value separately? Now, what is the difference between if I combine and I want to operate separately, right? What will be my synergy? The value. Will my value increase or not? If the value is not increasing, does not increase, there's no point of Paco, there's no point of taking over what? Active, because there's no value for it. Class, am I communicating? If you have
Yes,
question,
sir.
unmute your mic. If you have question, unmute your mic quickly. If you have question, unmute your mic.
Yeah. Mr. Ibrahim.
I'm with you.
Okay, thank you so much for the class. Please, I just want to ask, when we read the question that they gave to us, they made a statement concerning what's the name? Bako 4 to 5 of every share, something like that. So it's not necessary. We are not going to use that in this question here, right?
You don't. Okay. You are too fast. Just leave that part. We'll get there. We'll get there. So that is another part of that is another part of merger and acquisition, actually. All right. I think I have 5 questions on that. I think I have 4 to 5 questions on that, right? We'll try as much as possible to solve like at least 2 questions from share to shares. Then we'll solve one during our revision for those who will still continue with us for the revision class, who will still continue with us for the revision class, right? We'll do like 2 or 1. We'll do like 2 or 1. Then the remaining one will give you your assignment, right? So I think I'm done with this question. Then others, you attempt it. 5 marks, 5 marks, that is 10 marks, right? So that one, that's the two, these two, B and C is your assignment, right? So just send it to the platform and let's see what you have. Professional colleagues, Omo, it is well. Thank you. So, is there any other thing? I think we are done, right? For those who are here to pay for the pricing, right? It is just, you just have a limited time because we are planning ahead, and that is why we are next gen, right? We plan ahead. So don't forget, analysis is what we do. That is what we do on a daily basis, right? Report writing, and we are expecting different. Ican should come in different aspects, either CBN recapitalization policy, um, performance of thank you. Performance of what is it called? Financial ratios of financial institutions, right? Don't forget that the financial institution ratio is different from the normal ratio. There is what we call CAMEL, right? CAMEL, right? Capital adequacy ratio, right? Then asset base as well as management efficiency, sending and liquidity. We'll get there, right? Then ICANN can decide to come from the angle of tax, right? Don't forget that the new finance act has actually passed through in the third reading, I think second to third reading thereabout, right? And you would have probably, you are the training and you should advise your clients on what to do based on the new tax law. That is what we do analysis, right, on the Nigeria economy, not only on Nigeria economy as well as what outside as well. So this is an opportunity, just opportunity for, if you have someone that has been writing case study, just tell the person case study is gone, right? It's gone. So if you don't have question, okay, question exclusive before we go quickly.
Okay. So good evening.